Hi, everyone. Maria Widner here. Thank you so much for joining me. So today we're going to talk about a sensitivity analysis and scenario analysis and how to create those tables in Excel. Okay. So Cambridge Finance, it's a company that I founded, and we are here to do some Excel techniques for sensitivity and scenario analysis, which is always very important when we're creating financial analysis. Okay, so starting soon. So first thing is welcoming you to this webinar, and today we're going to explore how to use robust Excel sensitivity and scenario analysis. That's pretty much how I use sensitivity and scenario. Okay, so I'm just going to show you how we do this in Cambridge Finance. The main problem with Excel, like if you don't know how it works, if you're just like opening up a new model, is that it tends to feel like it's a black box. But if you understand the techniques, if you understand the formulas, the functions, and so on, then you can make a lot more robust, because then you can do some tests in your financial models, and then you can check if the model is good for purpose or not, even if it's not yours, or if it's yours, if somebody else's models, then you can run sensitivity and scenario, so then it can see if the model is working as you wished. And then the solution here is always to try to your own techniques on different models. And then with that, then you can build up your knowledge in terms of how to make sure that this each Excel function, Excel formula is working for you, and then you are doing the underwriting of your investments in the correct way. Okay. One thing that I would like to mention that is very, very important when we create sensitivity analysis. So I hope everybody here in this call understand what is a sensitivity analysis. Sensitivity analysis is, let me just show you what in an Excel would look like. But it's just this kind of what if analysis. Okay, so I'm just using here, I put here in yellow just to show you where we're going to add the sensitivity analysis. Okay, normally in my models, we don't have like the yellow bits, only like the inputs and the output coloring. But here with the yellow part here is what I want you to show you is what a sensitivity analysis is, which is pretty much changing, for example, the exit yield from, say, 4.75 to 5% to 5.25% and so on into the model, and then saying, okay, so given an exit yield of 4.75%, what is going to be the ungeared IRR, what is going to be the geared IRR, exit value, and so on and so forth. Okay, so this is the what if analysis. This is sensitivity analysis. What if your exit yield changes from 5 to 6 or so on and so forth. So this is a sensitivity analysis, and then it's very important to isolate those variables. And that's the main challenge when we are doing sensitivity analysis. Is not so much like the data tables, because this Excel can help us with, but like information of what are the variables that will have the most important impact, will be more influential in terms of your investments criteria. So for example, here, we isolated exit yield. This is an example. Rental growth, vacancy rate, construction costs, and discount rate. And then we test those changes into the impact on net present value. And then we can also, I think the net present value is the most important figure in our investment analysis, because it's going to inform the value of this investment. But also a lot of times people make investment decisions based on IRR. So you can check like, the base value on the exit yield, for example, is 6.5%. If it change plus or minus 0.5%, that will have a huge impact on your net present value. So yes, this is a very important variable that I need to isolate, and I need to play in terms of sensitivity analysis. Okay, so this is also important, because otherwise your sensitivity tables are going to get very, very heavy. It's when your Excel sheets start to become very slow, and you don't want to do that. One thing that when isolating key variables as well is because a lot of times people talk about the tornado charts. Tornado charts is one that you're going to measure the impact of a change in the variable that it's the input variable, exit yield, rental growth, and then it's going to have the impact on net present value. And then a lot of times people say, okay, we need to check the sensitivity of these returns based on a change of 1%, for example. So that's a sensitivity. So for example, if your yield goes up by 1%, what is the impact on IRR? If your impact of 2%, what's going to be your impact on IRR? So that's the whole idea of trying to have this tornado chart as well, but everything needs to be measured at the same amount. So it's 1% for all of them. Some people say about like 10%, but you can't really change the 10% of exit yield, up more 10% or less 10%, it doesn't make sense. But that's the idea of isolating the key variables and creating a tornado chart to identify which variables will have the most impact on your returns. Just so you know, from a practical perspective, in real estate, the most important variables are indeed the exit yield, right? So that's the capital value at the end, because property has a huge residual value. So it's a capital asset. Therefore, if you sell well at the end, you will make your returns. But if you sell in a bad market, then you're going to have a bad return, so to say. So that's also the problem with asset management, because like we work really hard in keeping the tenants in and keeping the building and everything, but then at the end, if you sell in a bad market, that the whole idea of asset management kind of falls through. So you have to be very aware of the forces that drive the market, and that in selling well, you will do your returns. Okay, so always the test is going to be on exit yield and rental growth. And I think that's the most important variables in terms of underwriting. Okay, so then I'm going to show you how to do this in Excel. So we're going to have like one variable data tables linking what's going to be, the what if analysis. As I mentioned, one of the most important or the most important variable for us is the exit yield, how much you're going to sell at the end. So we're going to test the exit yields and see what happens to your IRR, what happens to your net present value, what happens to the value, the exit value, and so on and so forth. Okay, so this is one of the exercises we're going to do here in this webinar. And then let me just check here how I'm doing with time. And then we're going to do a two variable data table and conditional formatting as well. Okay. And then what we're going to do here is also the scenario analysis and model clarity. When we're talking about scenario analysis, I'll mention to you, there is a scenario analysis in Excel that we shouldn't be using, okay? But I just want to make sure that you understand that. And then quick wins and pitfalls, common pitfalls is the main quick win data table is amazing. You're always going to use data tables. It's an amazing productivity tool. If you come to my courses, you understand how I use data table across the board, even like to create, for example, debt structures. If I want to compare the different offers we get from debt or equity, then we can use data tables there as well. But then one thing about data tables that it's a pitfall is that sometimes it will make your spreadsheet very heavy. This is a problem that I'm facing less and less as the world move on, as Excel becomes more efficient, as chips become more efficient, and so on and so forth. But you still need to be very careful with their data tables. Just don't put all the variables in there, because it's not going to make any difference anyways, because some variables are more important than others, and you need to make sure that you understand those variables. So this is what I would like to mention about the quick wins and common pitfalls in creating data table sensitivity analysis. Okay, and then we're going to do the closing and next steps for after we do the demonstration here. Okay, so I'm just gonna do the demonstration, or how teach you how to do this is, so this is a sensitivity analysis. Okay, so it's this, I've created that already. And then what we're gonna stress here, so it's also, some people call it the stress testing, is the exit yield. Okay, so if you're familiar with exit yields in real estate, so if you divide the rent by the exit yield, you're gonna come to the gross exit value. Okay, so you divide the rent. So here we have, so this is a model, just so you know, like it looks a bit, complicated here, but it's the model that we build in our courses in real estate, value add strategies and financial models. So we build these models, and then once everything is built, then we're gonna say, okay, what happens if our inputs are not correct, or we want to stress our inputs. We want to, because we're not 100% sure that the yield is going to be exactly 5.25%, right? Like in 10 years time, a lot of things can change. In 5 years time, a lot of things can change. So we need to be able to stress those variables. So here, my assumption is that my yields can go. So my base assumption is 5.6, 5.25. But what I want to test here is what happens if it's 4.75? What happens if it's 5%? What happens if it's 5.25, which is the base case? In changing those variables, what is it going to do with your returns? So here we're going to have the IRR ungeared, i.e. without debt, with the geared with debt, exit value, developers IRs, and investors IR. So here is a GP LP model, so the private equity kind of co-investment side, in that your equity side might have like two types of distribution, one with what we call promote or carried interest for the developer, the sponsor, the GP, and one with the IRR for the LPs, for the investors. Okay, so this is the model that we use, like a prop company, and you can also build, and we teach how to build this kind of like splitting the equity, given the equity waterfall. With the ungeared IRR, geared IRR exit valued, okay, so all we need to do is we need to first off link what you're trying, like with the outputs that you want to stress, okay? We need to link this with your table. So we want to do the ungeared IRR. So we need to link here equals, and then we need to find where this ungeared IRR live. And then our ungeared IRR is in this table here, which is the in table summary, which is in O11, okay? So this is my IRR, and then you can have here the geared IRR as well. Oh, actually, I got the wrong one here. So we want the ungeared first, so equals IRR, and then we're gonna calculate here the ungeared, the geared IRR. So you need to link here outputs, and then your exit value. So the gross exit value, the GDV, is the gross exit value is the 1 billion here. It's quite a big, it's a real case study, by the way, this one that we're testing. Yeah, it's also maybe another thing I'd like to say, because this number is too big, and say like, it's 1 billion, you can also create formulas in the output. So if you say, I don't want it to be the big number, I want to be in millions, so you can do divided by 1 million. 1, 2, 3, just make sure that I have enough zeros. 1, 2, 3, 1, 2, 3, and there you go. Yeah, so it's gonna be 1,132 million, which is 1 billion and 13. And then the developers II and investors II. I'm not gonna do this in the interest of time because I want to show you more things. Okay, but it's the process is the same. All you need to do is link the outputs with this data table. And then what you need to do here is simply a data table. So you're going to highlight. So the way that this data table is structured is very important. Okay, so your inputs either to be structured as a column, which is my case here, or as a row. And then in that case, it's going to be the row as the output. But if it's the other way around, if your inputs, your stressing variables are in the row, then your outputs are going to be in column. So when we have sensitivity analysis data tables with one input variable here, which is the exit yields, right? So we're going to stress just the exit yield. Then you can have many output variables. So here, as an example here, we have the geared IRR, we have the geared IRR, exit value, and so on and so forth. I don't know how to turn off the Copilot thing that keeps coming up all the time, but it never helps me anyways. But just want to see here is the icon for Copilot. But what we're going to do here, so once you've structured the cells here with the inputs and the outputs, by inputs are the input variables, outputs are the calculations, okay, then you can highlight the table. So when we highlight the table, that's again another very important thing, because we need to highlight where the outputs are. So our outputs here starting cell V13 and go to X13. Okay, so this is where these are the variables we need to highlight. And we need to highlight as well the input variables, which is the 475, 5, and so on and so forth. And the exit yield here, it doesn't matter. It could have been empty or it could have something else. It's not that the exit yield is not going to link exactly the exit yield to your your tables. What is going to link here is the next step. So what is the next step? We're going to go to, now that you have highlighted everything, we're going to go, it's just that I need to see here where it is because the Zoom icons are in front of me. So we're going to go data, yeah, what if analysis, and data table. And then in the data table, you're going to see here you have row input cell, column input cell. So it can either take two variables to stress or one variable. In our case, it's just one variable. And our variables live in the column. So I'm going to click here in the column and say, okay, you need to change one variable. Which variable do I want to change? The exit yield. Yeah, so here in this data table here, you need to pay attention that the column input, so here your inputs are in a column, and they refer to here the exit yield, which it lives in S16. And once you do that, you click OK, and then your table here becomes a then you have here the sensitivity table. Okay, so if your IRR, if your yield goes down or 75, 50 basis points, then your IRR will go up by how much? 12, it's gonna go 12.2. And then if your exit yield is 5, then your IRR is going to be 11. Then if it's your base case, 15, 5.25, then your IRR is 10.7, and so on and so forth. So it's working. How do we know it's working? Because the higher the IRR, the lower the IRR. And that's what we expected to see anyways. Why? Because your exit value will decrease when your exit yields increase. Okay, so it's also good here for you to visualize that the greater the IRR, the lower, the greater the yield, the lower the IRR, and the lower the value as well. Okay, so that's expected, else we expected to see. So it makes sense. That's what we want to keep in mind, that the higher the yield and the lower the IRR. Another thing is that you can check for the sensitivity of your IRR. So let's say look at the geared IRR in relation to your exit yield. What do I mean by sensitivity as well? Well, if your IRR goes, if your exit yield goes from 5% to say 6%, so your geared IRR will go from 12 to 8. So your yield will increase by 1% from 5 to 6%, but your geared IRR will decrease from 12.5 to 8.8%. So that means that 1% change in your yields will have an impact of around 3.5% in geared IRR. Yeah. And then a 1% change in yield will make your exit value change from 1.1 million to 990. So you're gonna lose 200 million if your IRR, your exit yield goes from 5 to 6%. So also it's a way for you to test the sensitivity of your exit yields to your outputs, your exit value, your geared IRR, and so on and so forth. Okay. Wonderful. So this is what I want to tell you about the one-way data table. And as we saw, there are not only one-way data table, but there are two-way data tables as well. And then the two-way data tables is the same process. Okay, the only thing that we're going to do is that we are going to now change not only the exit yield here at the column, but also construction costs, for example. So you say, the more I'm going to increase construction costs, the lower is going to be my exit yield, for example. So that's also another simulation we can do. The only difference here is that we are going to create here sensitivity analysis, but based on two variables. One is the IRR and the other is the equity multiple. But if you do like just the IRR, then it's going to be equals, where does the IRR live? So say here's a geared IRR, so it's going to be 11.4%. Yeah, but then so what happens? We can only have one output if you have two input cells. So here we will have two input cells, which are the IRR, which are the exit yield and the construction cost, but we can only have one cell for the output. What we could do here, this is another technique, but let me just show you how we're gonna first link this IRR with the two variables here, which is construction cost and exit yield. So for the exit yield, you know how to do it, is the column that is gonna be changed in the exit yields. Now we need to link the construction costs with your model, okay? So we want to stress, what happens if your cost is lower 10%? What happens if it's lower 5%? What happens if there's no change? That's your base case. What happens if it increases by 5%, increases by 10%? Okay, so we need to do this test. So how we're going to do this test? You need to link these inputs here, right? We need to link with these inputs here with your development costs. What are the development costs? So here, what we're going to say, okay, my hard costs here, so that's not construction costs. What we're going to do here is going to be the hard costs. Okay, so hard costs here. We're going to say, okay, what happens if my hard cost goes up by 5%, 10%, or decreases? What's the impact? So how are we going to link the minus 10%, 0, and 10% to the model? You need to link it here. Only you have the hard costs here. You need to say, okay, what happens if it's not 431 million is 500 million? It's 10% more, it's 10% less, 20% more, and so on and so forth. So here what we're going to say is that it's going to say, okay, what happens if it is this amount here times, and then you want to open brackets, so 1 plus what? Minus 10, minus 5, 0, 5, and 10. So that's how you link it. And the way to link it is create a dummy sensitivity analysis. So that's a dummy sensitivity analysis. So you go in AE12, and then you close here the brackets, and I'm going to say that's 431. So what does it mean? It means that if this variable here changes by 10%, oops, not 10, 10 is going to be too much, isn't it? 10%, then it means that your development cost here is going to change from 431 to 437. If it is, for example, 30%, then it's going to be 30% more, and so on and so forth. So you get the idea, right? So what we need to do here, we need to just link this variable here, this dummy hard cost variable here, with your total construction cost. So how we're going to do this? Again, we're going to say, okay, I'm going to highlight now the whole table. Okay, I'm going to highlight. And then we're going to say, okay, what if analysis, data table, and it's going to be, what is the data table here? Row. What is the row scenario now? The row is the difference, the delta in your construction cost. So it's going to be 0%. And then what we're going to do, we're going to stress minus 10%, minus 5, 0, 5, and 10%. The column input cell is the same process we did with the exit yield before. So we're just going to link this with the exit variable there. Okay, so here's what we're going to have. So in your exit yields here is going to be the exit yields inputs that you had in your formula. And then now what we're going to do is, okay, we're going to stress the construction cost. How are we going to stress the construction cost? We create here a dummy variable, and then this dummy variable is linked to your hard costs. Okay, so if your hard cost is 400 million, it's going to be 440 million. If it's 10%, 480 million. If it's 20%, and so on and so forth. And then you create, go, okay. And then this is where, sensitivity analysis is pretty helpful because it calculates everything in one go. Okay, so Control Shift 7, and then here you go. So this is your IR. The only thing here is that my IR is not working. No. It's because we need the percentage. Okay, the percentage. And then what we can do here, right? We can do here is say, okay, I want the color coding as well. Yeah, color coding. So you're going to go home and then conditional formatting, and then we're going to have color scales, and then we can use the color scales like the traffic light. Yeah, and then what will be this traffic light? Well, obviously, if your hard costs, if your construction costs go down and your yield goes down as well, you're going to have an amazing IRR. But if your construction costs go up and your yield goes up, then your IRR will suffer. So the travel of direction of this data table is correct, because the higher the costs, the lower is going to be your IRR, and then the higher the exit yields, is the lower is going to be your IRR, okay, your net present value, equity multiple, whatever you are trying to calculate in this case. Okay, so that's how you do the two-way data table. Another thing is, and then that's when we need to be careful here when we're doing this kind of data tables, is because we need to think about the correlation of the variables, which is not very clear here from the sensitivity analysis. What is not very clear? Because normally what we expect is, if you increase your CapEx, your hard cost, for example, the tendency is that you're going to increase the capital value, and therefore your yield is going to be lower. Okay, so also there's a way for you need to think about it, like, okay, so if you have to start thinking about the pair of the variables. Like, does it make sense that I'm going to increase the variable and the other one will increase or decrease? So in this case, it's like I'm going to increase the construction cost by 10%, but then is it possible that my yields are going to increase by 1%, 2%? It can be, and cannot be. It can be because, like, this is I've calculated already my yields on the base case, and then this difference is just because of the fluctuation of the market. Or it might be that you want to say, okay, the more I spend on construction costs, the higher it's going to be my value. And then that case is not going to, like, this relationship doesn't work very well, because expect the more you spend on CapEx, the more valuable your building, the higher the value of the building, therefore the lower the yield. Okay, so there's also, like, you have to start to think about the pair of the variables, if they go together or not, because otherwise the output doesn't make sense, your analysis doesn't make sense. So you need to be very mindful of that as well. Another thing about the two-way data tables is that because you just have one output, it's very hard for you to test the sensitivity, because, for example, if the construction cost goes from 0 to 5%, right? So that means, like, if your yield stays the same, then it's going to be, you're going to lose 0.5% in IRR, for example, right? So the 5% increase in construction costs means that your IRR is going to decrease by 0.5% if your yield stays at 4.75%. Okay, so you have to be careful a little bit about the way you're gonna look at the sensitivity analysis, because if you have, for example, just one way data table, then all this is already your sensitivity analysis, because you're gonna say, okay, your exit yield, the impact it has on my returns is by, every 0.5% increase in exit yield, then I'm going to lose 100 million in terms of in IRR, no, in exit value. So 0.1% increase in exit yields means 100 million that I'm gonna lose in exit value. Okay, so you can test this kind of like sensitivity analysis, which for the two-way data table, this is not gonna be so much the case. Okay. So this is what I have time to talk to you today on the exit yields, the one-way data table and two-way data tables. Okay, we do have the scenario analysis as well, that I think might be another session that we're going to talk about scenario analysis. right? How to do that. Just so you, as you are here, don't ever use the scenario analysis that you have in Excel, because here, if you have like data, what if analysis, there is this thing here called scenario manager. Don't use that ever, ever, ever. Okay, just so you are clear. So we need to use a dynamic scenario manager. Okay, and then we can show that next time. Right, so this is how much time I have to talk to you about sensitivity analysis and scenario analysis and data tables as well. Okay, I hope it was helpful. Of course, there's so much more that I would like to talk to you about. So therefore, if you're interested, please do join me in my courses. Okay, and then you can get all the Excel templates and everything. Okay. So the key takeaways here is isolate the variables. Don't use the scenario manager from Excel, and then please start with one variable, and then you can get two variables with many outputs, with one output. And then I would, if you're interested in doing more with Excel, please join my courses, and also I'll teach you not only Excel, but the whole underwriting process, the thinking about how you're going to manage the expectations of the investors as well, like what is that they need in terms of IRR, how the economics work in terms of a spreadsheet. Okay, so then I leave my contact for you. You have, of course, my email address and our company's details, but do reach out if you are interested in learning more, coming to our courses, or if you have questions about the underwriting process, appraisals, valuations. We're always here to share our knowledge with you. Okay, so thank you so much for your time today, and I hope I'll see you in our next webinar. Thank you so much.